Inventory is classed as a current asset, which means it's something the business expects to sell or use within the next 12 months. Essentially, inventory includes all the goods a business holds for the purpose of selling or using in production. This could be boxes of products sitting in a warehouse, items being counted in the stockroom, or goods arriving on a delivery truck. The key point is, inventory is not just physical stock. It represents money tied up in goods the business intends to convert into sales. Inventory can actually come in different forms depending on the type of business. Raw materials are the basic components used to create a finished product, like fabric and other ingredients. Work in progress, often called WIP, includes items that are partially completed. These are not ready for sale yet, but have already had some labour or production costs added. Finished goods are the completed items that are ready to sell to customers. Inventory has a major impact on several areas of the business. First, it affects profit. When a business sells goods, the value of inventory becomes an expense called cost of goods sold. The higher the cost of goods sold, the lower the profit. It also affects cash flow, because buying too much inventory ties up cash that could have been used elsewhere. Inventory is a big part of working capital, which tells us how much short-term resource the business has. It directly affects the cost of goods sold calculation, which we'll look at later. And finally, inventory affects business valuation. So inventory isn't just a number. It influences the overall financial health of the business. Now let's look at one of the most important rules in inventory accounting. Under accounting standards, inventory must always be valued at the lower of cost and net realizable value, known as NRV. NRV is simply the selling price minus any costs required to make the sale. These can include packaging, delivery to the customer, or sales commission. The reason we use the lower figure is to follow the principle of prudence. If inventory has fallen in value, perhaps due to damage, expiry, or lower demand, we cannot overstate its worth. So if NRV is lower than cost, the inventory must be written down. This ensures that the financial statements reflect a realistic value of stock. Now that we understand what inventory is and how it must be valued, the next question is, how do we actually calculate the cost of our inventory? There are three commonly used methods. The first is FIFO, first in, first out. Here, we assume the earliest goods purchased are the first ones to be sold. This means the stock left at the end of the period is valued at the most recent prices. The second method is AVCO, average cost. This takes the total cost of all inventory purchased and divides it by the total units, giving an average cost per item. The third method is LIFO, last in, first out, where the most recently bought items are assumed to be sold first. It's important to note that LIFO is not allowed under IFRS, but you may still see it in some countries. These methods affect profit, closing inventory value, and your financial statements differently, so choosing the right method is crucial. Let's look at how inventory movements are recorded. When inventory is purchased on credit, we debit the inventory account because the amount of stock we hold increases. We credit trade payables because we now owe money to suppliers. At the end of the period, we adjust inventory to calculate the cost of sales. The formula is opening inventory plus purchases minus closing inventory equals cost of sales. This cost of sales figure is the amount transferred into the profit and loss account as an expense. So inventory movements impact both the balance sheet and the profit and loss. In the statement of profit or loss, the cost of sales figure is shown as an expense. Sales minus cost of sales gives the business its gross profit. In the statement of financial position, which is the balance sheet, the closing inventory figure is shown under current assets. This is the value of the stock the business still holds at the end of the period, valued using the lower of cost and net realizable value, and calculated using a costing method like FIFO or AVCO. So inventory impacts both major financial statements and plays a significant role in measuring profitability and financial position. Let's look at how to calculate inventory values using the FIFO method, first in, first out. FIFO assumes that the earliest units purchased are the first ones to be sold, so the flow of costs reflects the actual physical flow of many businesses, especially those handling perishable or fast-moving stock. At the start of the period, the business has 50 units in opening inventory at £40 each. During the period, they purchase 30 units at £42 and another 40 units at £44. That gives a total of 120 units available for sale. We then assume that 60 units have been sold. FIFO means we start allocating cost from the oldest stock. The first 50 units sold come from the opening inventory at £40, and the next 10 units come from the first purchase at £42. This gives us a cost of goods sold, or COGS, of £2,420, which will be taken to the profit and loss account as an expense. The remaining units form our closing inventory. We use 10 of the 30 units purchased at £42, so 20 remain, and none of the second purchase has been used, so we still have all 40 units at £44. That gives a closing inventory value of £2,600, which is shown as a current asset on the balance sheet. So to summarise, FIFO gives us a COGS of £2,420 that goes to the P&L and a closing inventory of £2,600 that goes to the balance sheet. This slide shows how the FIFO calculations flow through the accounts using T accounts and financial statements. Let's start with the inventory T account. We begin with an opening balance of £2,000, which represents the value of inventory at the start of the period. That's 50 units at £40. During the period, the business purchases additional stock worth £3,020. Both of these are debited to the inventory account because we are increasing an asset. At the end of the period, we transfer the cost of the units sold, £2,420, out of inventory and into the cost of sales account. This reduces the inventory balance. What remains is the closing balance of £2,600, which will appear in the balance sheet as a current asset. Now looking at the cost of sales T account, you can see the £2,420 being debited from inventory. This becomes the cost of goods sold in the profit and loss statement. In the P&L, we have revenue of £5,500, COGS of £2,420, leaving a gross profit of £3,080. Finally, in the balance sheet shows the closing inventory of £2,600 within current assets. This represents the value of the goods the business still holds at the end of the period, valued using FIFO and the lower of cost and NRV rule. FIFO affects both major financial statements. It determines the cost of sales in the P&L, and it determines the value of inventory in the balance sheet. The T accounts help demonstrate the movement of inventory through the accounting system and show how opening inventory, purchases, COGS, and closing inventory all link together. Let's look at how to apply the net realizable value test, which is required by International Accounting Standard 2. ABC Limited produces electronic headphones. At the end of the period, we need to check whether the inventory is valued correctly. International Accounting Standard 2 tells us that inventory must be valued at the lower of cost and net realizable value. And this is a key rule in financial reporting. The selling price per unit is £55, and the business will incur £3 of costs to sell each unit. This might include packaging, delivery, commission, or other selling costs. So the net realizable value per unit is £55 minus £3, which is £52. For the 60 units we have in closing inventory, the total net realizable value is £3,120. We then compare this net realizable value figure to the cost of closing inventory, which we previously calculated using FIFO. The first in first out valuation gave us a closing inventory cost of £2,600. Because International Accounting Standard 2 requires us to take the lower of the two values, we keep the inventory at £2,600. The net realizable value is higher in this case, so there is no write-down and the inventory remains at cost. This figure, £2,600, is what appears in the balance sheet under current assets. So after calculating cost using a costing method like FIFO, we must always apply the net realizable value test to ensure inventory is not overstated. Now let's look at the inventory control account. The purpose of this account is to record all movements in inventory at cost, not at selling price. This aligns with International Accounting Standard 2, which requires that inventory is measured at cost unless net realizable value is lower. Inventory is an asset, so increases in inventory are recorded on the debit side and decreases are recorded on the credit side. We start with the opening balance brought down from the previous period. This is the value of the inventory the business already had at the start of the period. Since inventory is an asset, opening inventory appears as a debit balance. Purchases represent goods bought for resale or for use in production. Because these goods are added to stock, they increase the inventory balance and are therefore recorded on the debit side. Carriage inwards, also called freight in, is added to the cost of bringing inventory into the business. Delivery costs directly attributable to inventory form part of its cost. Because it increases inventory value, carriage inwards is also debited. When goods are returned by customers, we must reverse the original cost entry because the goods are now back in stock. Reversal of cost of sales for sales returns. We return inventory at cost, not at selling price. We record decreases in inventory on a credit side. Transfer to cost of sales, COGS. It's the biggest credit entry is the transfer to cost of sales. This represents the value of inventory that has been sold during the period. Once it's sold, it is no longer an asset, so we credit inventory and debit cost of sales. This is the same figure you later see in the profit and loss statement. Purchase returns, also known as returns outwards, are goods that we return to our suppliers. Because these items leave our inventory, we reduce the asset by crediting the inventory control account. Abnormal losses. If inventory is damaged, stolen, expired or otherwise unsellable, it must be written off. These abnormal losses reduce the amount of usable inventory, so they are recorded as credits. This ensures inventory is not overstated. Closing inventory. At the end of the accounting period, we calculate the closing inventory value, normally using first in first out or average cost. Closing inventory appears as a credit balance carried down because it represents the portion of the asset that remains. In the next period, this becomes the new opening inventory and moves to the debit side.